Hi, everybody. I'm Rick Edelman. Thanks for joining us for our final webinar of the year. And it is what you'd expect it to be, the year in review, the 2025 highlights, and a look at 2026. And helping us do that is Zach Pandl. He is the head of research at Grayscale. Zach, so good to have you back with us. Thanks for joining us today.
It's my pleasure, Rick. Great to see you. Excited to do this.
There's really nobody better to be having this conversation than Zach. As head of research at Grayscale, of course, the leading crypto asset manager. Zach's been in the financial services industry for decades, comes from the TradFi world, Goldman, Nomura, Lehman, and has been around and seen an awful lot of this. And it's like so many, Zach, you made the leap from the world of traditional Wall Street over to the crypto world. You know, I've yet to see anybody go from crypto to Wall Street, but I've seen a whole lot of Wall Streeters go to crypto. So
Good point. I never look back.
I bet you haven't. And I would assume, I would hope that for everybody, Grayscale is a household name. But just in case not, give us a minute on Grayscale.
Yeah, some of the key stats up on the screen here, but Grayscale, I think, yeah, a household name among many, at least prospective crypto investors. But we are the largest crypto dedicated asset manager in the world. We've been doing this since 2013, which seems like a very long time in the context of crypto. About $35 billion under management and a wide range of products running from, Bitcoin to BitTensor, an AI-related project, and everything in between. So really kind of covering the waterfront in terms of crypto investment products.
One thing I want to mention, in case some folks don't know it, you're a little too modest, Zach, to not highlight it. We all know the incredible importance of the Bitcoin ETFs when they launched in 2 years ago, almost 2 years ago, right? January 10 of 24. And what that meant for the crypto marketplace, for adoption among individual investors, as well as advisors, institutional investors. What I just want to highlight is that if it weren't for Grayscale, none of that would have happened. It was Grayscale's lawsuit against the SEC, against Gary Gensler, that forced the SEC, and they're losing that lawsuit, and the court forced the SEC to rescind. It's what the court called arbitrary and capricious denial of Grayscale's application for a Bitcoin ETF. If it wasn't for your leadership, we wouldn't be where we are today. So kudos to Grayscale.
Well, I appreciate that, Rick, and maybe I'll lay down my modesty for 1 second and just the way that I think about the story, tying it to what we're going to talk about today is 2023, Grayscale won its lawsuit against the SEC. 2024, the Bitcoin and Ethereum ETFs came to market. 2025, we had the Genius Act on stablecoins and tons of SEC-related policy changes, other agency-related policy changes. In my opinion, 2026, the next big thing will be market structure legislation for the crypto industry. So I see the lawsuit, really as part of this whole continuum
Yeah.
of regulatory clarity for the industry and asset class.
Yeah, when the historians look back and document all this, that is going to be very, very prominent in their history is the Grayscale
Appreciate it.
action against the SEC. Good for you. So this is an opportunity for you to ask questions. Many of you already did when you registered for the event. You gave us questions. I will be hitting Zach with those. You can add your own as we have this conversation. Just go into the chat. Actually, go into the Q&A box. That's even better. And type in your Q&A there. I'll be checking that as we go. This is an effort to be as timely and topical as possible. So we're going to start with the most timely and topical news of all. 3 minutes ago, the Fed cut interest rates by 25 basis points. So Powell gave a speech, told us what's going on. Zach, what's your reaction to the Fed interest rate cut?
Yeah, this is a real rapid take, but I was able to multitask enough to at least know what's going on. Look, they gave some guidance that potentially future cuts are likely. They also started growing the balance sheet again. I'm hesitant to call that quantitative easing, but this quantitative tightening that we had been going through, we can say that is over here. So I think overall a dovish meeting, a meeting that is going to be interpreted as broadly accommodative for markets, and I think that extends to broad equity market indices, et cetera, but also definitely to crypto. So I think a good outcome for the crypto asset class heading into the end of the year. Of course, it's been a bumpy stretch here the last 6, 7 weeks. we have bounced a little bit. I think probably we extend these recent gains with the news that we just got here at 2 p.m. Eastern.
So the official title of this webinar is the highlights of 2025. Uh, None of the above. Let's face it. We were all expecting. I was. I think you were. Many of us in the field of crypto were widely expecting significant price increases in 25. We didn't get them. So talk about the year in review. What happened? Why? What does it mean for where we are? What are the under the headline pieces of news we ought to be paying attention to? And by extension, well, let's just start with all that. Give us a history lesson for this past year.
Yeah, absolutely. When I leave aside the price side of things for a second, to me it looks like a terrific year in terms of the digital assets industry and crypto asset class. And really, two mega trends stand out to me that I think will continue to be powering the asset class into 2026 and beyond. The first is macro demand for alternative stores of value. Bitcoin, Ethereum, these can be considered scarce commodities and alternative money systems that can be held in a portfolio, partly as a ballast to fiat currency risks. And that issue, the kind of macro imbalances that are driving that type of portfolio demand for crypto, just keeps getting bigger and bigger. In terms of year in review type things, the highlights would, of course, be the passing of the One Big Beautiful Bill Act, which sort of locked in the deficit path for the U.S. for the coming years. This is not a new issue. This is not Trump's fault. It's not Biden's fault. It's a deeply entrenched bipartisan issue related to entitlement spending. But the point is, the One Big Beautiful Bill Act was an opportunity to have a look at those issues and said, all gas, no brakes, essentially. We're going to continue on this deficit path. We also had the Liberation Day announcement and all the tariff issues, other big macro news. But that kind of on the macro side of things, clearly, in my view, driving interest to alternative stores of value. And that'll be things like physical commodities, gold and silver, and digital commodities, Bitcoin and Ether. I think that trend very much continues. The other big fundamental trend, as we've already touched on a little bit, is regulatory clarity driving institutional investment in the asset class. And the list is almost too long to go through in terms of the things that have changed. But as I mentioned at the outset, the Genius Act, a huge piece of that, bipartisan legislation passed through the Congress, signed by the president on stablecoins. So that's a huge piece. But there's been so many other things at an agency level, just to list a couple, getting rid of SEC Staff Accounting Bulletin 121. That was right at the beginning of the year. That clarified the rules around crypto custody. That was sort of a day one effort by the Trump administration. More recently, the SEC in September giving us generic listing standards for crypto exchange traded products, ETPs or ETFs, known more commonly as ETFs, a huge piece of it. And then the other element, I think, is that the banking regulators really making sure that there is no arbitrary treatment that keeps crypto-related businesses outside of the banking industry. Giving crypto businesses normal access to banking transactions. That's been a big push, of course, from the White House. So you could keep the list going, but regulatory clarity driving institutional investment, and you've seen that carry on not just on the changes but on the dollars. Big ticket acquisitions by leading companies like Coinbase and Crack and other major.
We had $2 billion IPOs this year.
And yes, and multiple IPOs as well, Circle, Figure, many others. And we'll see how that story unfolds into 2026, of course. So macro demand, regulatory clarity, to me, those are the big pillars. And I look back on the last year and just could not be more enthusiastic that we're working on the right asset class here, given where those things are trending. Now, price didn't go up. Why is that, right?
That's exactly what I was going to ask you, is that given everything you just said, an observer would say the price must have skyrocketed. Yeah. And yet we're pretty much flat year over year.
Yeah.
Why?
It's a good question. So I think some of it is that it gets priced in advance. There was hype around the election time. And if depending on how far back we look at Bitcoin's price, of course, some of this had been priced in anticipation. how I think about this answer for myself, though, is like, I think any markets professional knows that the prices of assets are determined both by the fundamentals and by the vagaries of capital flows. And sometimes those things are not always working in perfect sequence, although they tend to walk together in the longer run. Over the shorter run, not necessarily. And so I think the vagaries of capital flows, you had some profit taking this year by Bitcoin OGs, people that bought at $10 and taking gains at $100,000. You had a little bit of that at a couple points this year. And I think that there was some deleveraging, of course, in October. I'm sure something that you've covered on with your clients, a big deleveraging event in October. So the offshore sort of speculative trading part of the market that's based on futures is a bit downbeat at the moment. Look, I think all of this stuff is likely to come back. I think these are kind of conventional pullbacks in the market that we've seen over the, from early October to mid-November or so was a large but conventional pullback in crypto. I think valuations as we head into next year are going to start merging with the positive fundamentals. And I see personally a very bright outlook for the asset class for that reason.
And that's exactly where I wanted to go next. You're doing good at anticipating me here, Zach, which is okay. You've got a pretty good background on what happened in 25, the foundational structure improving, solidifying, clarifying, explaining pretty well the pullback or why crypto didn't skyrocket because of selling that was going on and deleveraging. Elaborate on what it means for 26. What are you looking to have happen, not just in terms of prices, but also talk about legislation and regulation?
Yeah. Let me start with the price side of things, and then let's turn to all the policy issues and the market implications of those policy issues. I think there are quite a lot of threads that we could pull on. But on price, let me just be totally clear, because I think the framing that especially many OG Bitcoiners or people that have been in crypto for a while have in the back of their mind, as you know, Rick, is the 4-year cycle sort of thesis. Crypto has been on this 15-year journey or so, and every 4 years, once every 4 years or so, you've had quite large pullbacks, what we call cyclical drawdowns, big declines in price that took sometimes 2 to 3 years before you got back up to the previous high. So this is what many investors are thinking about as we move into 2026 is what is the risk of something larger like that beyond the 30% peak to trough.
And by the way, 26 would be year 4.
Yes, exactly. So we've had 3 years of bull market. If it's once every 4 years, maybe we're on, and we're also 1.5 years after the Bitcoin halving. So people that I think focus on this shot clock sort of analysis for the price of Bitcoin are nervous, and you have a bit of a jittery crypto market looking into next year. I think for this reason, I don't see it that way. Our view is that we are in a sustained bull market, and that the 4-year cycle theory will be invalidated with gains over the course of the next year. Just to be kind of specific about that, we don't do price targets here, but in terms of just to articulate my view, we think that Bitcoin will see new highs in the first half of next year. So we touched a high 126,000 on October 6th. We think we will exceed that level at some point before June 30. So new highs in the end of the year. And exactly when that plays out, there's always a lot of variables. It depends on broader markets, et cetera. But I think just to emphasize that the structural trend to us looks valid. Macro demand for alternative stores of value and the regulatory clarity part, which I'll come to in a second, really driving the asset class. So I think we will continue to see new highs for Bitcoin and for other assets. And by the end of next year, we will say there was no 4-year cycle drawdown. Just to kind of dwell on this for a slightly longer, Rick, that what I would emphasize is just look at what's happening in the market and compared to last time in terms of the way that prices are moving and the type of capital that's coming into crypto. In these past periods, you had in every prior cycle, Bitcoin's price went up at least 1,000% over a 1-year period. You had these really large parabolic moves in price. And I think we know with the benefit of hindsight that a lot of that is retail, return chasing, momentum chasing, giving you these big parabolic moves in prices. We just did not see that this time around. You've had a 6x gain in prices since the low. So it's been a good stretch for Bitcoin, obviously. But it hasn't been this sort of parabolic increase. It's been a much steadier rise, a much more linear rise. and driven by the ETFs, which is a new type of capital, longer term advisor capital, institutional capital, building crypto into diversified portfolios. And these are going to be diamond hand investors that I don't think are going to, quickly sell after kind of doing their analysis on this emerging asset class. So the nature of the prices, the nature of the flows tell me we're not going to have a 4-year cycle downturn, and the fundamentals tell me we're heading up. So we're optimistic heading into end of the year. That's sort of on the price side of things. Now turning to the market structure bill and the regulatory side of things, I do have one kind of clear expectation here, which is that Grayscale expects a bipartisan market structure bill to become law in 2026. We think that this is going to get done. It is not done yet. There is still a lot of negotiation still to come. I don't think we're going to see much more movement on it before the end of the year, maybe some puts and takes, but this is going to be a Q1 business, really going to get running on market structure. And I think it's easy to forget that how important this is. Most intermediaries and most assets in the space still need this clarity. We've had a lot of progress, but we do not have, say, single federal regulators for the major exchanges or clear regulatory status for many of the assets in the space. And so this is what we're going to get with market structure bill. What is this likely to mean for for investors in the space? Well, I think a couple specific things, but for me, the kind of most important thing is that I believe we are going to clarify the regulatory status of more centralized security-like tokens, and that with a clear market structure bill, we're going to have a return of what I would call kind of digital asset securities or security tokens, meaning that normal centralized businesses like listed companies will be able to issue tokens as a part of their capital structure, because these types of listings will have a clear regulatory structure. So if you think about big public companies, they have stocks, they have bonds, they have hybrid instruments like convertibles and preferred stock. I believe in the not that distant future, many large public companies will have a token line item as a part of their capital structure. This is the type of thing that's going to get unlocked by market structure legislation, and one of the topics that we're enthusiastic about when we think about a couple of years forward. So lots of other changes likely from a market structure bill, Wall Street integration, Wall Street banks holding digital assets on balance sheet, executing transactions on the blockchain, clarifying the security and commodity status of all the assets out there, and allowing for new issuance to pick back up again. All of these things are waiting for market structure legislation to get in place. And I think next year we're going to see that bill kicking off what is another phase of this extended bull market.
So let's unpack some of that. It was great info that you provided on a wide variety of subjects. Let's unpack it. First, let's talk about the fact that you think the 4-year cycle is dead. Many are saying that the reason it's dead is twofold. Number one, the halving is becoming immaterial. Right now, you only get 3 1/8 Bitcoins with a mining reward. And with the next halving, that gets cut in half even further. It's such a small number of Bitcoins being issued at this point that it just isn't material to the market reaction the way when Bitcoin went from 25 to 12.5, for example.
Yeah.
The second is that we now have, and you alluded to this, a huge array of institutional investors in an unprecedented way. We never had that before. So when retail investors wanted to sell, there was nothing to offset their selling. Institutional investors are more methodical. They are, I think, less irrational. They are certainly more long-term thinking. I mean, pensions and endowments think in 100-year cycles, not the next week. And so when they see a significant price decline, they recognize it as a buying opportunity, whereas retail investors historically may not. Do you subscribe to those two theories, that the halving is less important and the institutional support is unprecedented? Do you think that's a factor in what's happening?
Absolutely, I subscribe to both of those things. I do want to say that I don't in any way want to undersell the psychological importance of the halving at some level. I kind of love the halving as a Bitcoiner in the sense that it's these moments that really highlight the mission that we're on, which is scarce digital money that is programmatic and transparent. So the halving is kind of an awesome event in crypto,
Mhm.
but it's well known. It's literally scheduled. We know exactly what block it's coming. So it gets priced in long in advance, and it doesn't seem like the supply numbers are big enough to move the market. And on the other point on institutions, look, I I think to put it as simple as possible, I think institutions will be on the bid for a long time in this asset class. We're just at the very early part of this process. The dawn of the institutional era in crypto. It's just getting started
Right.
now, as you know. And Rick, you've been at the forefront of this, and of course, educating the advisor community and many others on this topic. But we're just getting started. There are early adopters. Harvard Endowment and Abu Dhabi's sovereign wealth fund, et cetera. We know some of the list, but it's not a huge list, and that's just going to keep growing and growing
Right.
over time. So institutions on the bid, I feel strongly about that, and I think it really highlights. For people that watch crypto closely, there's almost a kind of divergence in sentiment among the kind of classic retail speculator, meme coin enthusiast types in crypto and more institutional focused types that are building businesses for the long run. I mean, if you have that kind of viewpoint on the industry, which is certainly where Grayscale sits, it's hard to be pessimistic. I mean, it just
Yeah.
feels like the future is getting brighter and brighter. Although I can understand how the meme coin speculative part of the market is a little downbeat, and maybe it stays that way. I don't know that institutions are going to put meme coins in their portfolio, so we are kind of segregating the market in some way,
Well,
and I think you see that in sentiment.
that's an interesting point that you're raising. Tell me if this is true or false, that we might be on the verge of seeing, for the first time in crypto's history, a divergence of uniformity, meaning that historically, if Bitcoin went up, all crypto went up, and if Bitcoin went down, all crypto went down. But now we are having a breadth of coins out there and tokens and NFTs, et cetera. And we're beginning to get to the point, to the notion you've made, where institutions are more likely to own Bitcoin than Dogecoin, that we might begin to see real divergence, just like you do in the S&P 500. You might have one stock going up while another is going down. They all don't all move in sync. Are we going to start to see that in crypto, where what happens to Bitcoin has nothing to do with what happens to Solana?
Yeah. I think you will see a pulling apart in kind of broad categories. The short term, day to day ups and downs. Of course, there'll be always some correlation, like you see in other asset classes. But I think a kind of pulling apart of the trends. The way that I like to frame this is when you think about the Genius Act, think about that regulation on stable coins. This is very specific. The Genius Act says there are regulated payment stable coins in the United States, which have a specific set of rules and responsibilities, and those will have specific rights. They can be on corporate balance sheets. They can be used as derivatives, collateral, these types of things. They will gain some rights by having following those rules. And then there's other stable coins which are experimental and offshore and not going to have that same access. Maybe we will see something like this for the broader asset class, where you have assets that have clear use case, sustainable revenue, access to regulated platforms and institutional adoption going one way, and other assets that don't have a clear regulatory status, don't have an obvious use case or any revenue, don't have institutional bid, kind of staying stuck in a crypto past, a kind of legacy set of assets. Maybe that's more. I don't know that that's going to be entirely sorted out over the course of 2026, but this is the kind of trend that I expect. Institutional investors will be extremely targeted. They're not going to just buy things because they have high market cap, or they like the story or something. They're going to zoom in very carefully. And this is the conversation we have all the time. They're going to zoom in. They're going to look at the fundamentals. They're going to look at the risks, and they're only going to pick the things that they really want. And I think that you will see a kind of pulling apart of the
And
leaders and laggards.
and when they make that decision, that's a committed decision. I mean, Harvard is the
Right.
best example. Harvard was one of the very many naysayers in the space. I think it was 6, 7 years ago, they said that they thought Bitcoin would go to zero before it went to 100,000. And then they made their first Bitcoin investment this year at 116,000.
That's
So
amazing. Yeah.
egg on their face. But when Bitcoin then fell, they tripled their investment, and they've now invested almost $500 million. because they took advantage of the buying opportunity of the price going down. In other words, if they liked it at 116, they had to love it at 95. So instead of selling in a panic, they double down because they're long-term focused. So that's, I think, a fundamental difference between an institutional investor and a retail investor.
Absolutely.
You agree with that?
Absolutely. You're going to see a completely different buying and selling type of pattern where institutions, as you say, they're going to look at these pullbacks as a gift. As a gift. And of course, success in every market is getting good assets at compelling prices and then exiting those same assets at much higher prices. So low prices, if you believe in the thesis, is a gift for an allocator. I think many institutions will look at it that way, and they want to buy dips. They don't want to buy into FOMO. Where they may have suboptimal returns. They want to take advantage of these pullbacks. I think that dip buying by institutions is something that we will see all year.
So now let me go to another item that you mentioned a moment ago regarding regulation legislation in 2026. You expressed a lot of optimism for what was called the Clarity Act. They've now changed the name to something less cute, but essentially the same bill. I was surprised that we didn't see that bill pass in 2025. Were you surprised?
If you would have asked me earlier this year, I would have said there is a good chance that it gets done. Look, I'm not terribly surprised at this stage. And I think taking a step back, we need to remember that this is a mammoth piece of financial services legislation. Think Dodd-Frank or Sarbanes-Oxley or Gramm-Leach-Bliley, these like 1,000-page tomes that we do once every 10 years or so in the U.S. So reflecting on what it is that they're trying to do, it doesn't seem that surprising that it's taking a little while. And honestly, the debate will be intense. There are a bunch of there's bipartisan support for getting this thing done, and it needs to get done. Of course, crypto is going to keep growing and growing, whether there's regulation or not. The point of bringing in regulation is to allow it to grow in a responsible way that protects consumers, protects the financial system, and kind of integrates more and more into mainstream finance. So, it's appropriate to have the industry regulated, and it's probably overdue. So there's.
So having said that, just yesterday, the American Federation of Teachers,
I saw this.
Why they said this. I mean, I'll speculate with my conspiracy theory, but the American Federation of Teachers came out and said they oppose this crypto legislation. They think it's bad for the safety of the American public. It's not good for teachers or investors or consumers from a consumer protection perspective. Why they felt compelled to issue such a statement that seems to have absolutely nothing to do with their mission of education is a whole separate conversation. We know that they're liberal, that they are democratic, and that Elizabeth Warren and Bernie Sanders are very close to the AFT. We can only speculate if there was an agenda going on there. But the fact that they came out, a very powerful lobby group, came out opposing this bill. Simultaneously, last week, Senator Bernie Moreno, Republican of Ohio, very, very strong crypto supporter, said that he's not happy with the current status of the bill, and he'd rather see no bill than a bad bill. Given these kinds of statements, comments recently, and the midterms coming up next fall, how optimistic are you that we will see the legislation prior to the fall elections?
I think it's exactly the right question, Rick, and I have followed all these news stories. Let me try to give a clear answer. We think this is going to get done, and I think there's bipartisan support for it. That being said, if it doesn't get done, if we somehow see crypto become a partisan issue ahead of the midterm elections, I do think that can be considered a short-term downside risk. So in terms of just thinking about the risks next year, there are other things, Fed policy, other things that we could talk about. But I think it's fair to say that if somehow crypto were to become a excessively partisan issue ahead of the midterms, I would consider that a downside risk. And I'm optimistic for the short term, especially because it is bipartisan. I think it's important that these issues remain bipartisan to get long-lasting regulatory change. All that being said, I agree with Moreno on that point in the sense that I would rather have something good later than something bad right away. It's important to get this right. Decentralized finance to me is the most interesting thing I've ever encountered, in my professional career. And I think it will really transform financial markets. We need to make sure that we know how to do that right, that we provide the right protections for developers, for that we can safely integrate this software into traditional tools, all these types of things. So it is important to get right. And if it doesn't get done in 2026, but we get something properly done later, that will be fine. So short-term downside risk, if there's a delay and a lot of partisanship, it doesn't change the long-term thesis. This is just technology that provides benefits compared to the stuff that we have already. So we're gonna get there. We're gonna get, full adoption of this technology and lots of clear regulation in the fullness of time. It's hard to predict how the politics will shake out in an election year. You have my view. I think it is reasonable to say downside risk if we don't see the market structure bill pass.
So, given all of this, I haven't, I'm not sure I can recall a period of time in the past where there's been so much going on in the space simultaneously. Given all of that, what are you monitoring to gauge what's happening in the marketplace? What do you recommend advisors pay attention to, either resources or statistics or facts? And to that extent, talk about the research and data that Grayscale offers as one of those resources.
Yeah, absolutely. Happy to talk about that. We can talk about themes in the market, at anything that will be helpful. Look, in terms of kind of classic, well, I'll plug my research. So we are research.grayscale.com. We are writing all kinds of thematic and market type of research, really any topic that is relevant to investing in the asset class. We have likely written about it, and we're a resource for our clients whenever they have questions. Blockchains are not businesses. They are open source software running on networks of computers. So they're not businesses, but they do have fundamentals. And the most important fundamentals are really the on-chain data, measures of what is happening on this network that's processing these transactions. And so we look at things like users, transaction counts, transaction fees, capital, or what's called total value locked, applications, developers, all of these fundamentals. And when I tried to kind of distill it down into a single number, if I had a desert island kind of request for blockchain analysis, if you will, somebody asked me to price a blockchain from the desert island, I would want to know its fee revenue. Fees there's lots of different measures, but fees are hard dollar exchanging hands between one person and another. And so they're very hard to game or manipulate these statistics, and therefore they're more comparable across blockchains. I can look at Solana and Ethereum and Binance Chain and Tron all together because the fundamentals are broadly comparable. So those are a bunch of them, and I would say fees are the single most important fundamental if I had to pick just one. And so we stare a lot at that and try to think about what's it going to take for this blockchain's fee revenue to 5x, to 10x, to 20x. What is that going to take in terms of users, technological changes, or price per transaction, all these types of things, and try to think about fees. Now, it's not the only thing. Just like looking at revenue is not the only way that we're going to value a stock, but it's a pretty good quality indicator. And in a space where people are often very lost, where do I even begin? How do I start to put a price on this thing? I think starting with fees, a very good approach. So we go back to that one very often. You'll see that frequently discussed in our research.
One of the big questions advisors are trying to resolve is the asset allocation question. How much exposure should I recommend to clients? What are you seeing advisors recommending? What is it, if anything, that Grayscale is suggesting?
Yeah, a bunch of ideas here. First, zero is an active position. Okay, so crypto is at a place where you don't have any crypto. You're something like 1% to 2% under the global benchmark. So you're already starting with an active trade if you have nothing. And so I would say get off zero is the very first recommendation. And I think that's just the standard advice about owning the market portfolio. That's one way to think about it. Now, what's the optimal amount? The academic answer to this question is about 5%, meaning if I have a kind of conventional 60-40 portfolio and I'm doing really conventional mean variance optimization, academic type of exercise, moving it into the crypto asset class, the Sharpe ratio maximizing number is around 5%. So that's a very kind of classic mean variance answer. And some people want that answer. And then what we spend a lot of time on, talking to our clients, the same as you do, Rick, is try to say, what is the particular investor's goals and needs and risk aversion and all this kind of thing, and how do you parameterize it around that? So there may be investors that are younger or growth oriented or high risk tolerance, and they are especially focused on the macro risk to bonds and all this kind of thing, and maybe a higher number is warranted for those investors. Certainly, it's a much higher number for me than 5%. At the other extreme, you have investors that are just getting started. Let's say it's an advisor that has wants to begin building a position. They want to do with new dollars rather than rotating old dollars, and so they start building a position with new dollars, and they start less than 5%, 0.5%, 1%, 2%. They may even try to manage the risk in some other ways by doing a covered call strategy, say, which can reduce your volatility a little bit compared to just say straight Bitcoin. So get off zero. Think about 5% as that kind of academic number, and then think about your own particular portfolio. What kind of investor are you? What other types of risk do you have in your portfolio? How much discomfort are you going to get from a 30% drawdown like we've seen recently? And think about risk taking along those lines. So there's no one investor, no one right answer, but these are some of the talking points that we get talk with investors. I'd say maybe one other thing that I could get across, Rick, where to put it in a portfolio, always it comes up, and we just try to hammer the point that you should think of crypto as part of your alternatives bucket. You have stocks, bonds, other alternatives, and that alternatives bucket can be a wide range of things: hedge funds, private equity, private credit, infrastructure, other commodities, etc. So crypto fits in there. It's a diversifier. It's a source of return in your portfolio that's not going to move one for one with public market equities. That's what alternatives are all about. So it fits in there at about those parameters that we've discussed.
Now, if the advisor doesn't have a 3-bucket approach, stocks, bonds, alternatives, they merely have a 2-bucket, stocks and bonds, I'm guessing you would take it out of the stocks.
From a risk sense, that is often how people will approach it. We see, like in practice, we see a lot of rotation from growth equities to crypto, like where a dollar may have bought some kind of, let's say, Mag 7 stock or a kind of a high growth, tech-oriented equity position, that dollar will instead go into crypto. I think that's a very natural approach, because given the risk weights and all this. That being said, we do encounter the bond thing also, because partly what is driving interest in Bitcoin and Ethereum especially is demand for alternative stores of value and fear of inflation and fear of unsustainable debt and deficits. And so some investors say, I don't know that I want so many bonds. 40% seems like a lot of bonds given their return prospects. Maybe I should try for more growth-oriented stuff and more cash maybe to kind of manage the risk. So we see a wide range of things. But your point is correct. On the margin, a lot of it comes from growth equities.
And it does make sense to consider withdrawing from the bond portion for the simple reason that a lot of people own bonds as a hedge against stocks. So if your goal is to diversify away from stocks, you don't need bonds to do it. You can use crypto to do it. So that further supports, instead of a 58, 40, and 2, you could stay 60, 38, and 2 to accomplish the same thing.
Exactly.
Now answer the other half of the question, which I didn't ask you yet. That's why you didn't answer it. So I'll ask you now. If you're at 5% as a baseline for an allocation, what is it you're buying with that 5%? Is that exclusively Bitcoin? Is it something beyond? Talk about what you're seeing advisors doing from an allocation perspective. What are they buying?
Yeah, absolutely. I'd like to answer this by saying, approach investing in crypto the same way that you would approach investing in other asset classes, and you'll have a good experience with it. Do your research, buy dips, think about risk, the right amount of risk weighting given how much risk tolerance you have. All this sort of standard stuff applies. So the standard rules apply, I think, which is that what you want is exposure to the crypto asset class and all the things that are going on there. Innovation from public blockchain technology, essentially. The innovations in digital money and digital finance that we're getting from this technology. So, Bitcoin is the right place to begin, but you're not getting enough diversification with just that asset to all the other use cases. You're not getting that much, say, beta to stable coins or beta to tokenization themes. You want to move beyond Bitcoin. So diversification makes sense within crypto in the same way that it makes sense in other asset classes. The difference is that it's a very top-heavy asset class. The top five assets are something like 90% of the investable market cap. So and there's an economic reason for that. These are networks, and so they have big network effects. And so you're probably always going to have a top-heavy asset class with a lot of giants and a long tail of many smaller assets. And so what you want to do is have just some sufficient diversification across the major assets in the space. Couple ideas. Bitcoin, Ethereum, and Solana. That's often what crypto investors call the majors. Now that we have those three assets in efficient ETF structures, that's a great place to start. I like to expand that slightly to what we call our crypto starter pack portfolio, which is Bitcoin, Ethereum, Solana, and Chainlink. I quite like Chainlink, infrastructure provider, core to the tokenization thesis. We think that that's also a great fit for advisors. Also, there are diversified index-based products. So we have a product like this, Grayscale CoinDesk Crypto 5 ETF. This is top 5 tokens weighted by market cap, automatically rebalancing like an index fund in equities or bonds. So these are great approaches for beginning diversification. I would say the main thing with, yes, some diversification. No, you don't need 500. Something like 3 to 5, maybe slightly higher than that. These are about the reasonable amount of diversification for a top-heavy sort of network effect dominated asset class like crypto.
And what about picks and shovels?
Yeah. Chainlink, a great example of a kind of picks and shovels, and I'll give that pitch quick, just as maybe to give a clear answer to that. Chainlink is probably my favorite picks and shovels idea. What Chainlink is middleware that is going to help tokenization actually be a reality. So the tokenization vision I hugely subscribe to. I think the amount of tokenized assets is going to go up 1,000x in the next 5 years. That's my working assumption. I think that's a totally reasonable number.
The Secretary of the Treasury would disagree with you. He just said on Fox Business the other day, it's going to happen within 2 years,
Okay.
and that's a 100,000x. He said the entire securities market will be tokenized within the next couple of years. It's astonishing.
Well, I hope he is right. That's maybe that's the optimistic scenario in my distribution. So yeah, so maybe I need to up my my I always thought my multiple was already pretty big. I need to up it a little bit more. So anyway, but the point is, this is a mega trend in crypto. And it'll affect a lot of things. It'll affect the blockchains like Ethereum and Solana that the tokenization is happening on. But it has to actually become a practical reality. And there's lots of practical details that need to be sorted out, including things like compliance, proof of reserve, data connectivity, all this type of thing. And this is what Chainlink does. So Chainlink is a kind of picks and shovels or middleware project that is really closely tied to this tokenization vision for markets. It's probably my favorite of that particular category. Of course, there's a lot of other things going on, but I'll highlight that one. And shameless plug, available now in an ETF from Grayscale.
And the link is in the chat box, so you can go check that out right now. We've gotten a couple of questions about XRP to Ripple.
Yep, XRP, one of the largest assets and most liquid assets in the space, a battle-tested blockchain that was originally designed for cross-border payments, but really is expanding to other use cases today. I would think of kind of the thesis for XRP is that it has a very well-funded sponsor, a private company called Ripple that is doing lots of different things and is bringing XRP into their own process. Its long-term success will kind of be a question of whether Ripple is able to demonstrate the use case of its blockchain in the context of the things that it's doing, treasury management, custody, payments. If it can demonstrate the use case of the XRP ledger in its kind of home team cooking, if you will, then that would speak positively for the benefits of XRPL, the XRP ledger, to a broader audience. So it kind of one of the OG projects in the space, battle tested. I would say, finding its way in the kind of current market environment, but really sponsored by a, high quality business that's developing on it. And that's what I would focus on. Is Ripple able to kind of get quite a lot of value out of XRPL? If that's the case, other companies will find value from using it as well.
You mentioned earlier that you like to look at fee revenue on your desert island to
Yeah.
identify value. One of our attendees says, if that's the case, then does Bitcoin have any value because it
Yeah,
doesn't
good
generate
question.
any fees?
Good question. That's the nuance that I swept under the rug when answering this question. So we kind of have we say except for, and the except for is the kind of currency category. So when we look at crypto, we divide everything up into market segments, kind of like the GICS system in equities, where we divide the market up into energy and consumer staples and utilities, et cetera, et cetera. We divide the crypto asset class up in distinct groups. We call this our crypto sectors framework. More detail on our website if people want to double click on that. And one category is currencies. And these currency assets, I think they probably cannot be valued on that basis. There are other, we do look at that fee number. We look at other things like the breadth of the holders that are focused on this token. Bitcoin is an extremely special asset. It's hard to kind of sometimes get that across, but maybe I will highlight this. Why is Bitcoin so special? Well, think about it this way. We have no idea what's going to happen with Federal Reserve policy, the next Fed chair, tariffs, all these sort of things over the coming year. We know that the 20 millionth Bitcoin will be mined in the first week of March. It is just a kind of programmatic, transparent, consistent money system. And it has a huge global base of enthusiasts, users, holders of that asset. And I don't think that, and it doesn't generate a lot of fee revenue, but this idea that we need a money system like that in today's day and age, I don't think is going anywhere. So Bitcoin, we need to sort of evaluate in a slightly different way, but fees for most of the other things, a great place to start.
Kathy is asking for your advice, Zach. How do you frame a conversation with her firm to encourage them to adopt crypto into client portfolios? That's still a big impediment, isn't it? Most RIA firms have still not yet begun to allocate.
Yes, and there's early adopters, there'll be late adopters, as you see all the time in your work, Rick, we're in the process of tipping all those dominoes over in some sequence, and we'll eventually get to the last domino. But that process is going. Look, I'd like to make two suggestions. The first, I feel fairly strongly about. The first is talk about diversification. Don't talk about blockchains and crypto and stablecoins and token. And why are we having this conversation for our clients, for our business? It's because we're trying to build an effective diversified portfolio, and that is not easy. And you need to find things that are not the same as the bets that you're already making. And so digital assets, the crypto asset class is one of those things, producing strong returns, strong risk-adjusted returns, and those are not highly correlated with public market stocks. And so it's a natural diversifier. So that's why we're talking about this in the first place, is portfolio diversification. I think that helps move the conversation along as opposed to starting with the technology. And then people often ask, okay, what's the one-liner on the technology that is helpful? We like to frame it as, public blockchains are giving us innovation in digital money and digital finance. That's what this technology is all about. You can make it as complex as you like, but we're trying to invest in innovative technology for diversification. That's where the conversation usually begins.
You've offered two good answers to Kathy's question: portfolio diversification, technological tech stack. I'm going to add a third to that,
Please.
which is far more selfish for the firm, and that is business success. Investors have clearly demonstrated an interest in this. 65 million US adults already own Bitcoin and other digital assets, including a large percentage of your firm's existing clientele, without your firm knowing it, because your firm hasn't helped them. They've gone elsewhere. They've bought it away from the firm, which means that's AUM your firm is missing out on. This is client generation, client referral that you're missing out on. If the firm fails to incorporate crypto into its business practices, you're going to lose that business opportunity to the competition, which is engaging. So it is in the firm's motivated self-interest to add crypto to the portfolio platform, to say to the client, we can now help you. We can incorporate it into the diversified portfolio for all the reasons that Zach just mentioned, which is better off for the client. And you can capture new clients, new assets, new AUM, new referrals, and build the business more effectively. So the firm should realize it doesn't matter whether you like it, Mr. or Mrs. Chief Compliance Officer, Mr. or Mrs. Chief Investment Officer. I don't care whether you like it, your clients like it. And you can either do what Vanguard did 18 months ago and declare we're never going to allow our customers to buy it, or you can do what Vanguard did last week and say we've changed our mind, we will let them buy it. Because in the past 18 months, Vanguard discovered how many billions of dollars they failed to attract because of their refusal to add the product to their platform. So simply recognize from a business model perspective, your job is to give clients what they want and to do it in a way that protects them from their own bad behavior. Avoid the risk that they're going to get ripped off from a crypto fraud by searching the web on their own. Avoid the risk they're going to overweight and take too great a risk. Avoid the risk that they'll buy high and sell low, the classic behavioral finance errors that every client makes all over the place. Do your job. By helping them invest in a prudent, effective methodology, increase your value add to the client. The client will not only be better off, so will the firm. So if you can't appeal to their diversification metrics and the technology metrics, appeal to their EBITDA.
Amen.
And we do this kind of consulting all the time to firms. Kathy, if you would like us to talk to your firm, the C-suite, the CEO, CIO, CCO, we're happy to do that. Just reach out to us. Happy to have those conversations. We do it all the time. Brian asks a question, Zach, which is a really fundamental one. You talked earlier about tokenization. I kind of piled on with Bessett's statement on Fox the other day. Hey, Brian's trying to get his head around this. What's the point? Why would a Fortune 500 company issue a token instead of issuing a share? What's in it for them? What's the benefit to the Fortune 500 to do that?
Yeah, great question. So let me just clarify, tokenization can mean existing assets. Typically, that's what, when people use the term in the media, that's typically what they mean. But what I mentioned earlier was potentially new issuance. Let me touch on both of those things. So existing assets, we have trillions of dollars of stocks, bonds, real estate, derivatives, that can be tokenized, meaning we can put them on a public blockchain. The point of this is to give user benefits. By putting it on a different set of financial infrastructure, you get user benefits. And what are some of those benefits? Well, we can transact on nights and weekends. We don't have to wait for the cash to settle to buy another asset. We can permissionlessly integrate into lending type of programs without talking to our broker. These types of things. So it's just a sort of back-end financial markets innovation. Your experience managing assets, looking at a website, pressing buy and sell on your ETFs is not going to feel all that different. The difference is it'll just be a little faster, cheaper, and more convenient, especially on nights and weekends and public holidays. So tokenization is just about that back office innovation in finance. Now, on issuance, so my thesis, and I would say this is maybe an out of consensus view and sort of looking ahead, given the regulation, what are things going to look like a couple of years down the road? I believe that companies will issue new tokens. Now, why to do that? I think of it as basically the same reason why you might issue a hybrid security like a preferred stock or convertible bonds. You're trying to target a kind of niche investor base and reduce your cost of capital in some way that's also convenient for managing the firm. So what can tokens do? Well, first of all, tokens can go anywhere. It can be global, doesn't have to be isolated to one particular type of investor. It can maybe be tied to a particular revenue stream, like a particular project. It also may have different governance rights compared to equity. So sometimes when we issue equity, we become concerned about control issues from a kind of from a corporate the standpoint. Who's running the business? Who's controlling the voting shares of the business? We can potentially issue tokens that give an equity-like return, but not necessarily the same governance rights. So it allows a kind of customization of corporate capital structure and allows more reach to a broader global investment base. And I think you will see this. I think you will see tokens become part of corporate capital structure for that reason. We're at the early stage of this. I think you will see the beginning of some of the leading companies over the course of the next year. And as it's facilitated by the regulation and all the rulemaking, that takes a little while to play out. You'll get there. It'll be another significant piece of growth for the industry.
The simple reason that companies, the Fortune 500, are going to issue tokens is the same reason that we went from mutual funds to ETFs. ETFs are technologically superior. They're cheaper, they're faster, they're more transparent, and tokens represent a similar technological improvement over shares. It's just enabling businesses to operate faster, cheaper, safer, with greater transparency. What's not to love? So this is why you're going to see tokens dominate in the marketplace over the next few years. Why the Secretary of the Treasury said the entire securities industry, $68 trillion market, is going to be tokenized in just 2 years. It makes perfect sense to do it. We've only got a couple of minutes left. I'd like you to spend that just a minute or so, if you would, Zach, talking about how Grayscale supports advisors. I've popped up the screen here to illustrate. Give us a little bit on this.
Okay, yes, great. Thank you for the plug. Look, some of it is with the research that we've already talked about. So we are all over the place with written research, with webinars. We do work with Rick. We also do lots of custom events with particular platforms. So the research content, a huge piece of that, and that's both educational elements, the basics. What is a blockchain? How does Bitcoin work? All that kind of thing. Risk management topics like quantum type topics, and then all that kind of market analysis, Fed meeting, fund flows, all that type of stuff. So kind of a full research suite. I'm out in the world seeing advisors all the time talking about this. Second, we have a sales force around the country. That's what that first column is showing. Similar model to other platforms, but we very likely have someone close to your home office that can do in-person events, either with home office resources like myself, or with your clients, or whatever is needed. We do any kind of custom event like that. And then we're doing larger kind of group events. We call them Crypto Connects. We go around the country where we bring advisors together in one room for a half-day long educational type event that cover all the aspects of investing in crypto. So the basic research type of stuff, product work, all the regulatory and legal aspects, other advisor perspectives, hearing from some of your peers on how they incorporate crypto in your portfolio. So this is part of the whole package. Of course, I didn't mention the products. We have a kind of wide range of products as well, in terms of, that are complemented by all this work. And these are low-cost Bitcoin and Ethereum ETFs, BTC, ETH, a very straightforward way to start building those assets into your portfolio. And then increasingly, other altcoins, Solana, XRP, Dogecoin, Chainlink, some of the ones that we've mentioned on this call. And investors can expect to see a significant further increase in Grayscale's product suite over the coming year. As that regulatory landscape evolves, we're going to offer more and more of these products to our investors. So we are a full-service crypto asset manager. Similar to, the experience should be the same as the other asset managers you work with on other asset classes, but we are just fully dedicated to the crypto mission. So when you think of crypto, we want you to think of Grayscale, both on the product and resource side of things.
That's awesome. Thank you for that summary. It was really terrific, Zach. This has been a fabulous conversation. A lot of info as we look back on the year and anticipate the year to come. And we're going to be with you next year. Our first webinar of the new year is January 14th, how the ultra high net worth and family offices are investing in digital assets. That's 2 p.m. Eastern on January 14. If you have not read my white papers, where I talk about why the allocation ought to be at least 10%, double Zach's 5, and as high as 40% for those high-risk, aggressive investors. Read my new white paper. The QR code is right there. You can get it for free at dacfp.com. And if you really want to demonstrate to clients you know your stuff, become certified in blockchain and digital assets. Get your CBDA professional designation. 18 CE credits. It's listed in FINRA's database of designations. First half of the course, all about the tech. Second half, all about practice management. You'll learn how to talk about this with clients, understanding the investment thesis, regulation, taxation, compliance, everything you need to be able to build your business and generate new clients, new assets based on crypto conversation. And we invite you to join us in Dallas in June. We offer the oldest and longest running crypto conference exclusively for financial advisors. It is June 8 to 10. It's the latest and greatest of what's happening in the world of crypto up to the moment. You'll love this 2.5-day event. It's really terrific. And if you haven't read my Amazon #1 bestseller, now's your chance. The Truth About Crypto. You'll love it. It'll give you a really good understanding of what all this is. It's a great holiday gift for clients. And one final thing, totally off point, which is my brand new book, The Truth About College. It is the biggest worry parents have, the cost of college. Should their teen go? How will the teen have a great success? The book debuted last week, already came out as a #1 Amazon bestseller. You'll learn the top 10 mistakes parents make, the benefits of a college degree, the perils of a degree, the 12 biggest mistakes clients make, how to graduate debt-free, and 20 conversation starters for parents and teens to have adult, serious conversation for what will be the biggest decision in a teen's life. So I encourage you to pick up your copy of The Truth About College. Zach, again, thank you so much for joining us here today. Great info. I wish you the happiest of holiday seasons. We'll see you in 2026.
See you in 26, Rick. Thanks so much.
Thanks, everybody.